This is incredibly embarrassing, but this is how we're going to start. I'm wearing the same shirt that I wore yesterday.
Oh my God.
Wow.
Do you, do you smell?
I don't know. I mean, I'm in a freaking
I don't
booth
know.
by myself.
This is Top Line.
This month's sponsor is Closed, the industry leader in win-loss analysis. The only thing worse than missing quota is not knowing why. Win-loss analysis with Closed provides detailed and unbiased feedback directly from your buyers. So when you're looking for answers, you'll have the concrete data-driven solutions you need to make the strategic decisions with confidence. If you're curious about how win-loss analysis can boost your win rate, give Closed a try. We'll do a free buyer interview for one of your deals. Visit freebuyerinterview.com now to claim your free interview. That's freebuyerinterview.com now to claim your free interview.
How was your AI conference?
Amazing. Amazing. Austin, you talk about all this AI stuff all the time, and I'm like finally starting to buy in. I'm finally becoming a believer of it.
Did you learn something there that you're like, oh shit, like I need to do this?
Well, so here's the backstory on it. There was a founder in Philly that went in July to this YPO conference. Am I allowed to say that, or is this getting bleeped out?
What? You can say YPO.
I can say YPO. Okay.
I'm a member of YPO.
Okay. So this YPO conference on AI.
Why would we bleep it out?
Community?
Because it's a competitor or something?
Yeah.
Whatever. Come on.
So, on with the story. And
I'd be blessed if they considered me a competitor.
he called me. So it's a good friend of mine, co-founder, CEO of this company called Revzilla that sold very successfully. Anthony Bucci, motorcycle e-commerce. Check it out. He calls me at 10 o'clock at night. I'm like, why is Bucci calling me? I'm like, okay, I'm not taking this. And then he calls me again. He double dialed me. I'm like, all right, well, it must be important.
Somebody must be dying.
AJ, I just got done with this conference. It's 14 hours long. I'm like getting him to set up a Boston specific one because he's coming in for an AI conference with Harvard. He's going to do it at Harvard Faculty Club. I've got like 10 people in. Are you going to join? I'm like, what?
Wow.
Sure. So I did. I signed up for it that night. That was the hard sell from Mr. Anthony Bucci.
From the Booch.
Bucci. I forgot about it. And then I was looking at my calendar this month. I'm like, fuck, I'm going to Boston inbound. And then I have a 1-day conference the very next week on a Wednesday. Whatever. I'm doing it. So
Is the Booch a Top Line listener?
He will be.
The old Booch face.
We're getting them one person at a time.
I remember the last time I saw Booch and he was passed out drunk on the floor, vomit all over him. I'm just kidding. I've never met this guy.
We were talking about, we had dinner last night and we were talking about the days of, Restore came up because we all know Steve Wells, and we were all talking about drips and the days of drips and getting your, being in Vegas and getting back on it with IV drips. Anyway, the conference was great. It was held by a lecturer that is touring 50 countries. His goal, 50 cities. His goal is to get 100,000 instructors.
Wow.
And we did it with YPO, but the idea is that charging what he charges, it wasn't terribly expensive, but expensive enough that he's going to make this free in countries in Africa and in India as well.
Wow.
For kids that are 10 to 15 on generative AI. So that was really cool. The really interesting thing, and Asad, you got me using Code Interpreter, which they've now renamed to Data something.
Yeah.
And I never really connected the dots, but when you start to work with large data and you start to train it with the API, it actually gets really fascinating, interesting, and really good. And then you connect that with Zapier or Zaps or anything that you want to, and you kind of create these little apps and these workflows along the way. So he took an article from the BBC written in Portuguese, and he set up a Zap to not only translate it and then summarize it, but then send it as a plugin to this thing called HeyGen, I think it was. And it was a virtual newscaster that read the summary in English of the Portuguese BBC article within 2 seconds. And then he set up Zaps to with Twilio to make calls and summarize the call or summarize the article.
That's so cool.
Wow.
Yeah, it was nuts.
This AI stuff, it feels like maybe it's got some legs.
Not according to Noam Chomsky. Do you guys want to know what he said
What
about
did he
AI?
say?
So he says this: the day may come, but its dawn is not yet breaking, contrary to what we've been reading everywhere. The Borgesian revelation of understanding has not and will not, and we submit cannot occur if machine learning programs like ChatGPT continue to dominate the field of AI. However useful these programs may be in narrow domains like computer programming or suggesting rhymes for light verse, we know from the science of linguistics and the philosophy of knowledge that they differ profoundly from how humans reason and use languages. These differences place significant limitations on what these programs can do. And we think that these are ineradicatable defects.
Narrow domains such as computer programming.
Yeah, I know. That's what I was saying. That's a pretty broad domain. You mean the thing that powers the entire world? Oh, yeah, very narrow.
I think he's getting a bit old.
Should we get started?
Let's do it. Let's get
do
kicked
it.
off.
All right.
Okay.
Go ahead,
Okay.
Austin.
So let's start with the market and tie into customer success and net revenue retention. So the CPI report is out. CPI rose 0.6% in August, which was the largest increase since June 2022. Gas prices went up by 11% during this period. So that was half the overall increase, which is why people are not feeling very alarmed because of this. Year over year, CPI was up 3.7 in August compared to 3.2 in July, but core inflation went down to 4.3% in August from 4.7% in July. It seems like the Fed's going to hold their rates steady. And as long as this is a blip, which is what the stock market thinks it is, because nothing moved in the markets when these numbers came out, then they will continue holding steady and might even decrease into next year. A new survey from Business Roundtable made up of CEOs from top US companies said that only 27% of the CEOs they surveyed expected to increase their US workforces in the next 6 months, down from 33% in June and 47% a year ago. The executives' forecast for sales and capital spending were flat, which suggests business conditions are holding up, even as executives reevaluate what were once more ambitious hiring and staffing plans. So clicking into technology, there is a really good Substack called Clouded Judgment, and this guy does an analysis on a bucket of about 60 or so cloud companies. And in his latest one, there was some really interesting information about net revenue retention. So net revenue retention for this bucket was steady at 120% from Q1 2021 all the way to Q4 2022. But then for the first time dropped down to 116% in Q1 of this year, and then again dropped down to 114% in Q2. This is the median. Top quartile was 120%. Best in class is considered 130%. We know that on the private tech side, the numbers are a lot lower. Jason Lemkin had a post today that for SMB SaaS, it's generally 80%, but you have to get it to 100% for your business model to make sense. So it seems like the economy is normalizing, which is a theme we've been touching on a bit in the last couple of episodes. Tech companies have really struggled with new business and retention during this period. Will things normalizing in the overall economy just bring these net revenue retention numbers up and then we're done? Or is there a systemic issue in customer success that needs to be addressed? Sam, you've been talking about CS and retention a lot. What are your thoughts?
I think three things. One is that this is part of the economy. So I think as the economy comes back a little bit, net revenue, I think my guess is that part of it is budgetary in nature, which is that there's just not as much room for upward expansion as there used to be. The second thing I think, and then I think two other broader things, one of which we've spoken about, one of which is to the point of your question. The one that we've spoken about is that I'm beginning to question. I'm fully on. I'm in my mode of questioning the fundamental premise and assumptions behind SaaS. Fundamental assumptions behind SaaS are that it's hard to change people's mind. So we will spend a lot of money to acquire a customer, but it's dramatically cheaper to keep the customer. And that's because effectively keeping them, once they change their mind for our product, they will continue to use our product unless significant forces impact their decision-making ability, or we really suck, or whatever it might be. And as we've talked about previously on this show, I my my instinct is that people change their minds and companies change their minds much more frequently than they used to, or than the underlying assumptions behind the software business models would assume. And I think that's enabled by the cloud. The cloud enabled software as a service, but it also enables switching vendors and providers more quickly or readily than has ever before been possible. And then the last part, which is to the point of your question, Asad, I think that despite, I still don't quite think, and this is what we've been talking about on the road to Nashville, and this is what we will be talking about in Nashville at GTM 2023, which is that the pre-sale funnel is well architected. The pre-sale funnel is still, new business is still the thing that we as CEOs grab onto with the greatest energy and enthusiasm. And it's because it's instant gratification. Salesperson has a deal in his pipeline, the deal comes in, we get the money, the scoreboard changes, everybody's happy. And I think the post-sale funnel, which is why Jocko calls it a bow tie, is dramatically less understood. And when I was on stage with Allison and Sid, we talked about how 43% of companies surveyed in a go-to-market survey did not have an architected customer journey post-sale that they are driving their organizations towards. And even Mark Kosselglow, the CRO of Catalyst, is talking about, he gave this talk at SaaStr. He had this post. I was trying to see if he wanted to speak on the show, but he is in an offsite, so he can't do it today, but we can have him on in the future. But he said, he gave this long talk about how retention is the key to driving all growth in recurring revenue businesses. And the Q&A afterwards was entirely about his time at Outreach and whether SDRs are effective and what's happening with outbound sales. And so I still think that companies, we haven't, despite Pendo and all of these other platforms, I still don't think we have algorithmic customer journeys mapped to behaviors that our customer success teams are driving. I am not convinced that we have the right profile of people working on customer success. I think that we still fundamentally, and I think we're swimming against the tide for the first two reasons, which is that people actually change their minds a lot. It's not that easy to keep to be the legacy vendor, not as easy as it used to be, into a really difficult economy. So, but to the point about CS, I think, and I also think it relates to the comments that AJ was making about the conference that he was at. It's also not quite clear. I think if we're going to see falling net revenue retention, that might be okay, but we have to rethink the investments we're making in CS and make sure that they're rationalized. And we might need more automation and fewer humans. What do you think, AJ?
So yeah, I think there's two parts to this. You touched upon both of them: the upfront go to market, and then the CS aspect of it. And I think the thing that you really interestingly said, in just terms of the rethinking the traditional SaaS metrics and that go to market, there was a really great tweet. It was a quote, actually, Peter Thiel. He does say some great things over the years, regardless of what we all think of him personally. But I think about go-to-market as distribution. And what he said was, it's better to think of distribution as something essential to the design of your product. If you've invented something new, but you haven't invented an effective way to sell it, you have a bad business, no matter how good the product. Superior sales and distribution by itself can create a monopoly, even with no product differentiation. Converse is true. No matter how strong your product, even if it easily fits into already established habits and anybody who tries it likes it immediately, you must still support it with a strong distribution plan. I thought that was really interesting because it touches on both sides of what we're talking about right here. And I think that the SaaS metric piece of it that was broken is because the distribution model didn't get really put as a part of the equation or the sales methodology. Sure, everyone talked about product-led growth or PLG. We talk about partnerships. We talk about community. We talk about channel. We talk about all of these ways as distribution. But how many of us as founders are really doing the upfront work to really figure out what that means? that upfront work goes on both sides of the equation. It goes on the go to market, but then it also goes on the CS side. What you just said, Sam, with when you were on stage with Allison about that post customer journey work is very fascinating. For QuotaPath, we've gone through a journey ourselves. I just got out of a meeting called our monthly business review. And each month we have a different topic. This month's topic was just about payouts milestone and how far from onboarding our customers are running payouts for the first time. And looking at all of the features and everything along that value chain to when they're getting there and where are they falling off on some of the conversions to be able to do that. So it's something that we really consider up front to be like, if you're going to buy QuotaPath as to run commissions, you got to pay your team, right? Pretty simple equation. But without digging into that customer journey, you don't understand. And it's not a CS problem or AM problem or a CX problem. It's a company issue. That's a company thing. That's a product opportunity. That's a management team. That's something that our marketing team should be thinking about. Our sales team should be thinking about in the value that we're selling up front. And I really just enjoy this conversation because it's hitting so hard right now because we're all in this like retention. But what does that actually mean? What do we mean when we really dig into the numbers, and how can we execute off of what we're seeing in the data?
There's something really interesting about the history of CS. So the first ever CS team was created by a company called Vantiv in 1996. It was a CRM company. And the problem they were solving was that they had really high churn at the implementation stage. And this was an industry-wide problem. So they came up with this concept of a CS team. And they would deploy this team almost like firefighters. Wherever they saw risk for churn, this team would get deployed. Not to manage every customer, that was the job of the account managers, but wherever they felt there was risk, they would deploy the team. And it worked well for them. The lesson I think we're learning over time, though, is that there's another way to think about this. So if you think of this original model like a cost center, there is a model in which customer success is a profit center. Winning by Design writes about this a lot, which is that if you give them onboarding, renewals, and enablement of the customer, well, now they can be a force multiplier. They can help you increase the long-term value of your customer. But then you have to rethink how you're staffing that team, the resource planning for that team, how you're comping that team. All of that has to change. So there are almost two types of CS teams. There's a cost center and a profit center model. The predominant model is the cost center model, right? And what ends up happening is whenever retention becomes a problem, we like look at it and we're like, shit, we don't have enough people. Let's hire into it. When Pavilion was revenue collective and the pandemic had just hit, you guys used to put out an economic benchmark survey. It was in Q2 2020. I still remember the stat. 52% of companies, while everyone was laying off, was still reallocating staff into CS, and 31% were going out and hiring into CS because when they thought there was retention risk and they looked at those teams, they were like, shit, we are understaffed. We need to give them more resources to be able to minimize churn risk.
So what happened then? So that's confusing to me because here we are 2 years later talking about the investment into CS. So what went wrong?
The thing that happens, I think, is that we don't learn lessons well in this ecosystem. I think over time, we evolve in the right direction, right? So if you think of marketing has SDRs, BDRs now, in some cases, Kyle Lacey as marketing leader, but runs the lead gen team so that he has all of the top of the funnel. I think that evolution is the right evolution, but I don't think we learn lessons really well and things flip on its head. The evaluation problem in tech is another example of that. We're dealing with the after effects of the valuation problem from 2021, 2022. And then in AI, we are again giving 40 to 50 times revenue multiples to Series A companies. So I think no lessons were learned. It's just that over time, we move in the right direction.
I mean, the other part of that is executives. And executives, do they have enough time ramp to be successful? And how long are they in the seats to get their frameworks and get the ability for them to connect with their customers, understand their market? That turnover, obviously, we have a lot of data to show that's increased. You don't think that's a part of it?
I think I was looking at this for the course I teach at Pavilion, and CMOs, CROs, and CCOs all have the same tenure. It's like 1.8 to 2 years, give and take, right? Depending on the cohort. I think that's enough time to implement shit and try and move things forward. I think, though, that not a lot of people are in the CS world are educated on the profit center model. I think it's it's a progressive idea. It's like Winning by Design put out a paper on it, and now they implement it in their clients, but it's progressive. It's not the status quo. So I don't think a lot of leaders know how to do that. I think they come in and they build a team that is the cross center model.
I also think, I do think it's a function of human psychology and of competing time intervals. And what I mean by that is it's just there's so much more instant gratification to focus on new business, because focusing on retention, one way you can focus on retention is, we're going to hire some save specialists, and and when somebody requests to cancel, we're going to triage and deploy a bunch of resources. But that doesn't really work. And that's because that people decide that they're going to churn well before they request to churn. And so, okay, if you want to get them when they request to churn, well, what's the work that needs to be done? Well, there's, as we talk about, there's a whole set of things that need to be done. First of all, you have to evaluate, do we have all the data that we need to understand their behavior relative to our product? Most of the time, sometimes the answer is yes. Most of the time, the answer is no. So then you say, okay, how long? I need to start collecting the data. Then once I have the data, I need to start building some kind of algorithmic inference, right? I need to build a model that tells me these are the behaviors that drive value and these are the behaviors that drive retention. Well, that takes additional time and additional investments in data science. Then you say, okay, I'm going to start making these changes, but we've all just agreed that people don't decide to churn, the day before they cancel. So I'm going to start making these changes. Well, when will I see the results of those changes? Oh, you won't see the results of those changes for 6 months after you start making the changes, because that's when people come up for renewal based on the interventions that you've begun to influence. All of that is a way of saying that all of the work that you might want to do is going to take a year and a half, 2 years long to really get good at it. And meanwhile, you raised a bunch of money, or you have growth expectations, and you have revenue expectations, and you're still holding on to the triple, double, triple twice, double three times ideas that if we don't hit our growth metrics, we really aren't very special, and we begin to look much more ordinary. And I'm not prepared to admit to my wife or to my husband or to my partner that I'm not special, because I am special. God damn it. I drive this electric car, and I'm just very special in a lot of different ways. I'm a good cook. I know exactly how. Anyway, the point is, it all takes a long time. And meanwhile, we're all in the pressure cooker of trying to hit monthly and quarterly numbers. And the easiest way to maintain the illusion, it's not even an illusion. It's the easiest way. It's just really, really hard to kick the habit, because it's the same thing as living a healthy lifestyle. You're not going to see. It's not a crash diet. It's not about being keto or being paleo. It's like you got to exercise every day and be hungry most of the time and eat less than the calories that you burn. And that's the way that you lose weight. And it's not rocket science. It just takes a while. And I think most people want an instant gratification, that sweet, sweet hit of new business. And even though they know in their hearts, well, if I sell this deal and it doesn't renew, I'll just be back here in a year. But you're like, you know what? A year's a long time from now. And right now, I'm just trying to make sure I don't get fired and that we have the right metrics that I need to hit my next funding round. And so I just think that these competing time intervals, it takes a lot of discipline to say we're going to focus on retention, and I really don't give a shit what happens to our top line growth rate. And if that means that we fall out of the sweet spot of beloved venture companies, unfortunately, that's what it means. It's the same way that a politician sometimes has to campaign on raising taxes or cutting entitlements, or, as Chris Christie said on the All In Pod last week. And it's not popular. It's not popular to say we're not going to focus on new business, and I really don't care what comes in from new business. I can't imagine a board hearing that and not being deeply frustrated. That's my take.
You are special, Sam. That's what I think.
Thank you. You're special too.
I think
you're really special.
Thank you.
Today's business landscape is full of uncertainty, and succeeding as a go-to-market leader has never been more challenging. Pavilion is here to provide you with the education, support, and resources you need to grow, learn, and unlock your full potential. Join more than 10,000 of the world's leading go-to-market executives in a private membership community designed specifically to fuel your success. Visit joinpavilion.com and use the code TOPLINE20 to get 20% off your membership. That's joinpavilion.com, and the code is TOPLINE20 to get 20% off your Pavilion membership. And now, back to the show.
That shirt is special. I can smell it through the screen.
I'm looking dapper, and I don't care what you say. The idea around expectation setting is what is really like just ruminating in my head as we're talking about these things, because you have these two worlds, and what you're really challenged with is how do you set expectations with this group of people while also ensuring that you're creating the right expectations with this and trying to keep them both happy at the same time. And it becomes this like world where we're context switching. CEOs are context switching every day, all day long, keeping a lot of things in their head and trying to be as transparent and open with their team, creating this level of trust and empathy that they have. But at the end of the day, they like all sometimes just feel like, oh fuck, I feel like I let this person down, or I didn't do this thing. And that's what really like eats at us as I think about it. And so yeah, from a big high strategy position, you have these expectations that you just talked about, Sam, in the triple, triple, double, double. But when you really zero it in on the day-to-day basis, it becomes a big challenge to what was that phrase that Brian Halligan talked about, where you're like you look in the sky and you throw up on your shoes or your feet or whatever he said. My point being that it's just very challenging to stay as grounded as we possibly can because of how like optimistic we are just about the future. And we've gone like a little bit off topic from where we originally started from, but it's just these are the things that we're dealing with right now that we know to be the challenges that we're
But
working
it's like the thing is like when you're problem solving in the moment, then AJ, what you're saying comes into play, right? And it's a good point related to that. But these are like fundamental choices that you make at the beginning of your business almost. And it feels like a lot of founders and a lot of executives don't really realize what the concept of a recurring revenue business is, right? Jocko says recurring revenue is the result of recurring impact. Like we're still running and these teams or structuring these units the way a company would if they were selling perpetual licenses. But we're not those type of businesses anymore. And so we should be a lot more excited about investing in keeping a customer once we've gotten them than we are as an ecosystem today. And that I think is a huge issue. I think in the good times, it's not a problem. So no one gives it enough attention. And Sam is right that new business is exciting. So everyone focuses on that. But if you have 100% or 110% NRR, it's on the list of things to think about, but you're not like super worried about it. But now we are seeing the power of great NRR. Snowflake has 170%, right? Even in the downturn, they've maintained high levels. And the impact that's had on their business is significant. So I don't know. I'm not very bullish on this. I think it'll take a long, long time for CS to function properly.
I think what you said something, Asad, you said we don't realize sometimes the consequences of the choice that we make early on in the company's formation. And I have been living that myself, certainly the past couple of weeks. And you're right. And again, I think this is why Jocko talks about phase shifts, that we're in a phase shift. And part of the phase shift is from growth at any cost to efficient growth, which is really like we architected these companies to drive top line growth because that is what we were told and that is what we believed would drive enterprise value. And now we're in a different environment. And this is, when you were talking about, you were worried that the recession would end and, you wouldn't have this learning opportunity again. And I feel I've never felt that more acutely than the past couple of weeks, that I'm really in this learning moment, really learning. And I am going to be super, super grateful for it. I was thinking about the end of this year, and I think I mentioned like the beginning of this year, how it started New Year's Eve and opening up bill.com and looking at our accounts payable. And having my stomach drop. And all of the journey that we've all been on this year, particularly, I think we're going to learn from this. It's just going to take some time. And part of the learning is that things take time. Part of the learning is that, we want to build these generational businesses, but most people don't want to build generational businesses. Most people are looking to flip. They're looking for the next fundraising round. They're looking to make sure that they're on stage with David Sachs and Chamath at the All In Summit. And I think the lesson, you can preach taking a long-term view, but you really got to believe it. You really got to believe it. You really got to believe that I don't care what this thing is worth. And that's been really powerful for me, is it doesn't matter what it's worth. What it matters is let's build a great company. And a great company has 20% operating margins. And so that's my goal. A great company doesn't just break even. A great company is profitable. And where I'm coming out on all of this, and so that's why we're very focused on retention, and we're very focused on what information do we have and what information do we not have. Let's go get the information that we don't have, and let's build those let's build the algorithm to tell us what we should be driving the customer success function to do in order to make people happy. And as a consequence of all of that, you realize, okay, well, if I'm going to do that, I got to make sure that I'm selling to the same kind of person with the same kind of problems. Because if I'm selling to 5 different kinds of people or 5 different kinds of problems, it's just going to make that whole enterprise, that whole that challenge 5 times more complicated. And again, the same thing. Well, why did we sell to all different kinds of people? Well, because they were there and we wanted to grab market share and we wanted to grow at any cost. Well, now we understand that the cost of servicing all of those different people is very, very high. And that if we had been willing to sacrifice a little bit of growth to stay focused on our ICP, we would be in a different position.
Yeah. The instructor yesterday in the AI conference made some pretty astute observations that were outside of the AI piece of it. And one of the things we talked about was what was the role of the CEO, and it was growth and cost, those 2 things. But the third observation around this was watch out for asteroids. And this idea of like, well, what happens when in the movie, any dystopian movie where there's an asteroid that's about to hit the planet, what happens? Well, the scientist makes this great discovery and it's like, oh my goodness, look, everyone, this asteroid's going to hit. What does everyone do? No, that's not going to happen. No way am I going to have to like do anything about the asteroid. And those asteroid movies, that's the thing. First you have to hire Aerosmith to play during those. And so that's the thought is you see this asteroid as a CEO and getting yourself to move, getting the entire company. And it feels like regardless of size, whether you're a smaller startup, whether you're 10, 15 people, maybe not that small, but whether you're 30, 40 people or 10,000 people, but getting the companies to really move and say like, this asteroid is going to hit. Now, it was in the context of generative AI, of like talking about the efficiency. And he brought up this story of a CEO that he was giving a talk to that had 60,000 people that worked for them. It was a giant CPG conglomerate, global company. 60,000 people worked for this company. Over the last 8 years, they've automated 40,000 people out of a job. But those 40,000 people still work there. They're the people that are so like the truck drivers that are sleeping in the back, like all of the logistics, everything has been about automation, automation, automation. And he said he doesn't want to be the CEO that has to stand up in front of Congress to explain why he fired 40,000 people. That was his reason. Now, how is that a true story? I don't know.
Isn't his board a little bit annoyed? Like, you spend all this money, dude, on like automation, all this shit. Like 8 years we've been on this thing, and you've kept everyone, and you spent the money. Like, what was the reason for it? Then just have everyone do things the old school way.
I mean, my guess is that there's some level of bullshit with it, but I think there's some obvious truths to it. So you have this, what you said, Asid, but Sam, it resonated well with Sam. You set out on this journey to be this thing, not realizing the consequences of these decisions. But then on the other side of it, not being able to change fast enough and make
I
other
think that's a really good point. I've been thinking about this concept of an A player, like we've been chatting about it as well. And I think nimbleness when you're small is just easy. But as you get bigger, I think how nimble your organization is dependent on the quality of their team. I think A players, one defining characteristic is that they're more nimble. And hence, if your company is full of them, your company is more nimble, whether you're 100 people, 500 people, 1,000 people. And I think companies that have lots of B and C players are just less nimble. You can't predict the black swan, right? Like that's the whole nature of it. So what you can do is create an organization that has that nimbleness built into it by the caliber of people you bring into it. That's probably the only way to handle it.
It's a combination of being nimble and being a really good communicator. Because the thing that gives people whiplash is constantly, you have to, what is AJ, what do you call it?
whiplash.
You don't call it whiplash, you call it the churn, the guzzle. You'll think of it.
Ooh.
I forget
Is
what
this
you call
an
it.
airplane term?
No, he calls it something. He's called it something in previous podcasts. But anyway, it's the up and down, it's the volatility. And so you have to be, the thing that happens as you get bigger is that it just becomes harder to make decisions, because especially once you make some bad decisions, you're like, well, I better be pretty damn careful. And so then the first part of it is sizing the decision the right way.
Yeah.
And then the second is just context, making sure, because it's always surprising. One of the hallmarks of great leadership and great management is the ability to communicate that context down to the levels of the different levels of the organization, so that people don't feel like, why the hell are they doing this?
Yeah.
And the thing that feels really disempowering to people is when you issue a prescribed directive without context. You say, change what you're doing. We were all running left. We need you to run right now. Go. And they're like, well, but why? I thought we were running left. And so the great leaders, the great managers are the people that can still get people to run right, but they can explain, hey, everybody, here's why. And then also maybe it's, I think we should run right. What do you think? Let me tell you the problem that we're trying to solve. And you tell me what we think we should do, and do all of that with agility, and do all of that where it's not 15 meetings for the sake of meetings, and where it doesn't, because that's also where things break down, is when people assume. I think there's like this growing culture within some people that again, remember, like so many people coming out of COVID, they didn't work in offices and they don't have a lot of work experience. And so some people assume that work is bureaucracy, as opposed to bureaucracy being the necessary exhaust of productivity.
Yeah, that's really interesting. A lot of people have never really worked in a tough economy as well, right? Like if you think about post 2009 till now, right? This downturn, that was a great market to work in. I think a lot of the lessons that group learned, a lot of those have to be broken for the market we're in and the market we're going into. And so that's actually not a small group of people, right? Like if you think about people that joined the workforce post-pandemic, that's relatively, people with 0 to 5 years of experience. When you think about like post-great financial crisis till this downturn, you're talking about people that are now VPs of sales that have never seen a downturn and have never had to learn these lessons. And that's quite scary to think of it from that perspective.
I can't tell you how much I'm learning about people who literally, they hear us talk about this stuff. Maybe it's even us. There's something about people that they see revenue, and they have not, because software businesses are supposed to have 80% gross margins. They cannot understand fundamentally, especially when businesses deteriorate, that there is a cost to revenue. They can't, it doesn't penetrate. You're like, what is the ROI of this activity? And they're like, well, it generated this much revenue. And you're like, but that revenue has all of these other costs associated with it. You can't just say that it's the revenue. Like when it all flows out, like there's only this much left at the bottom. That's what the ROI is. And there's just groups of people across that I run into all the time that they're like, listen, ARR grew by this much. We're like, yeah, that's true. But at what cost? What did we pay for the ARR to grow for that much? And it still is just so hard for people to resonate with that.
David Spitz had that post, AJ, that you spoke about, I think, in the last episode, where he showed that there were a lot of companies. No, this was a different one, where he looked at how much margin they created for themselves. So the free cash flow that they created and its impact on growth. And it was like to create 20%, they were losing 30 to 40% of growth. And so it really makes you wonder, like, how expensive that growth really was, how sustainable those business models were. We would look at those companies with 70, 80% growth that were now publicly traded companies. And what we're not looking at is that they were making investments that are not sustainable in any world for that type of growth. So it's not real. It's just fake business. It was like fake.
Well, that's what I was going to say. If SaaS metrics are broken, the guzzle, I'm using that term.
The thrash. It was thrash.
Trash.
That is a word that you say. Will you admit that?
Yes.
You say?
Yeah.
Don't lie.
Trash.
Stop
It's
lying.
a good word.
Yeah, but
You're
if I look
liar.
up synonyms to thrash, guzzle, I don't think comes up. Where does this end? The SaaS metric. If SaaS metrics are broken, what's the end game for SaaS businesses that are venture backed?
I think the end game is that they're worth less.
Well, I do have
Not worthless, but worth less.
Worth less.
Worth less, but maybe worthless.
Many will be worthless, but like lots are just worth less.
I was talking to
Should we keep if
to
we
an
keep saying
advisor.
worthless over and over, it'll lose all meaning.
I was
Worth less,
talking
worth
to-
less, worth less.
I am worth less, not worthless. That's a good t-shirt.
Worthless.
I was talking to an
Worthless.
advisor last week who
Less worth.
was talking about one of his companies that had to raise a down round. They raised it at $300 million valuation, and this was 2.5 years ago. They were running low on capital. They had like $1 million in ARR when they raised the 300 million, and so 300x multiple. The company's growing. They're at 7 million in ARR. What do you think they raised their down round at? It was an inside round.
Wait, so do the numbers one more time.
300 million was
60 to
valued-
300 million. What was ARR when they raised it?
1 million.
What the fuck? I don't understand. That's just negligence. That's negligence on the part of the CEO.
And the investors. The investors are batshit crazy there.
No, it's everybody. You don't want to do that. You're not, unless they sold $50 million worth of secondary, there's no outs.
Say in that, but when you're caught up in it and you're looking at the cash is king. Now you spending it is the negligent part. So that's the difference. That means
Well, and the fact that they had to.
All right. So your original question is 7 million.
7 million.
What did they do their inside round at? 50. I'll say 50.
85.
60s.
85. So go
Still
ahead.
more than 10x.
Yeah.
So, but
That's
here's the thing.
Bananas.
So they reprice. I was like, well, the common is worthless because they're underwater. He's like, no,
And also worth less.
they repriced all the options to the $85 million number. I was like, okay, well, that makes sense. So the dilution came out of the founders most likely, but wait a second. Investors, no, this doesn't make sense. So it's 3x participating.
3x.
So meaning
On how much
that-
was put into the company?
20 million. But
So 60.
well,
Oh,
the 60
wow.
they got to get back, right? But like, look, that's off of their original. Their original was 3x participating. All of the preferred is now 3x participating. So meaning that the company is going to have to sell for like $500-600 million for common to see anything
A penny.
material. And I was like, well, does the common
Worth less and worthless.
Yeah, this is a worthless business.
do you think
now.
the executives at this company know this?
I
No.
don't know.
No. The answer is no.
I think we've all.
Why is
I
the
think-
founder even doing it? Just take it to the back, kill it.
Gotta
go do
survive.
something.
Got to survive.
Mm.
Pride. I mean, also maybe it's fun. I mean, maybe it's still an interesting solution. I think, I've talked about this a lot, but forgot the guy. Oh, Rob Cohen. Rob Cohen is an advisor to me, and I always he's anybody that's been through. You need 2 economic cycles. I want somebody that came of age in the late 90s that has been through that like was there and senior during the financial crisis and has now been through this. And so here's what he said. He said, there is no company in the world that's worth 10 times revenue. That's the first thing that he said. He said, I don't believe it. It's not true. The second thing he said, because I was talking about one of our competitors, that's, and what is a community business? I was having this conversation earlier with someone today, and my friend said, it's an events business. That's what it is. It's not a tech business. It's not a software business. It's an events business, or his business is an events business and his business is a community business. He said, WeWork is a real estate arbitrage business. That's what it is. I don't care what you call it. So my point was that I said, this was 2 years ago. This was 2021. And I said, yeah, our competitors just raised $100 million. They're not really competitors. They're in our same space though. $100 million. They're worth $1.1 billion. And he said, Sam, when a company raises $100 million at a $1.1 billion post-money valuation, what do you think the investors think the company is worth? And I was like, I don't know, $2 billion? He's like, they think it's worth $100 million. And I posted that on LinkedIn, and Sahil Mansouri got, you don't know, he's tried to mansplain me. The point is that these company, with 3x participation, that's your price, my terms, that's like, tell your friends whatever the fuck you want to tell them. I'm getting my money out, just so you know.
Yeah. It really is that. That's intense.
Investors are always going to win. And I think this is another advisor that's purposely ambiguous. You're not going to understand. And I get it. That's the game. That's how venture works. I've been told this since day one, 12 years ago, when I first raised my round from Silverton Partners. And I was talking to a mentor, and I was like, hey, should we take this deal? Like, well, Silverton's good, but venture is venture. And that was the kind of the summary. And, you learn all these lessons along the way, and sometimes it works out and sometimes it doesn't.
I just think we just all got to be realistic and build good business. I mean, again, it's all businesses. It's all Buddhism. It's all Stoicism. It's all Marcus Aurelius. It's all just like, you cannot be playing for the exit. You have to be playing because you find a way to enjoy the journey. And the best way to enjoy the journey, I think, is to at least have amazing unit economics. If you want to burn capital, it's because you should be burning capital because you have great unit economics and it's defensible. Otherwise, build a profitable business.
I was talking to somebody at one of the Pavilion dinners, and he's like, the only way to create wealth is by having an outcome for product business. He's like, I have 3 or 4 at-bats left in life. I'm going to take those, and hopefully one of them works so that I can create generational wealth. And I found that interesting. Like, obviously it's true, right? Like, if you create a software business and it takes off, you can have a great outcome. But it almost was like, for a long time, people had forgotten there are other types of businesses that make money, lots of it. And there are many ways to create wealth out there. And we've said this now for a couple of episodes where that lesson seems to have been learned, where there are entrepreneurs that are now not just technical, that are building businesses. And just in the last couple of days, lots of people that I've spoken to that are not trying to go after venture early on, that are bootstrapping, and that are thinking about things like dividends. I find that very encouraging.
Yeah. And I wouldn't get caught. I just wouldn't get caught. The way to get rich is to build something that you own, is to own assets.
Yeah.
I would not distill it down to any kind of particular business. Yeah. John Malone didn't build a software business. Ted Turner didn't build a software business. Warren Buffett didn't build a software business. There's lots of ways to get rich. The way to get rich is to build something valuable and durable that people value, and to focus on the long term.
Buy low, sell high. Buy low, sell high.
So you got to own something to buy low that you can then sell high. The only way to not get rich is to make all your money off your W-2, off your paycheck.
There we go. That's a good note to transition.
All right, we got shout outs.
Shout outs, wins of the week, because we also have to get to Top Line Hotline. AJ, shout out.
I'm going to shout out Tyson Goltz. Tyson is a listener, and one of the 24 listener. We moved from 12 to 24 of listeners. Got me a note and said he was one of them, and that he loves the content and to keep it up. It was on a Monday morning at 9 a.m. Felt like a good start to the week. And shout out to you, Tyson. Thank you.
Oh, thanks, Tyson. God bless you, Tyson.
God bless. Mine is actually the Pavilion Slack channel. So we don't use Slack at STA, so I don't use Slack often in life. Actually, we use Google Chat. It's perfect for our size. It's perfect. Like all these other things are overcomplicated. But I don't spend a lot of time in Slack. The only thing I have on it is Pavilion. And over the last 2 or 3 days, I've gone active over there again. And I have had such good conversations with such great leaders. I just before this spoke to an advisor at Bain Capital, and we're going to do some work together. And it was literally, he reached out to me on Slack and we started chatting.
Go.
And so there is it's a really powerful place if you spend time. Like I've been one of those individuals that hasn't leaned into the Slack channel and gotten lots of value from it. I'm doing it now and it's powerful if you lean in. So shout out to that.
I'm going to give a shout out to the following people: Michelle Benfer, Mark Rosenthal, Mike Hoffman, Andrea Kyle, Nicola Anderson, Tom Glasson. Those are the chapter heads of New York, Boston, and London, but not in that order. We had a call going over the return of chapters in all of those cities. And I'm just telling you that it's going to be awesome. It's going to be awesome. And particularly in London. In London, there's 2 people leading a sales sub-community. There's 2 people leading a Women of Pavilion sub-community. There's a marketing sub-community. There's a fractional consulting sub-community led by Guy Chiswick. Nicola Anderson is just doing a fantastic job. And I also want to give a shout out to Tom Andrews on our, so I guess his formal title is Director of Insights, but he's really our RevOps guru and runs revenue operations for us. And we have systems in place now that are going to enable the community to enable itself, which is sort of the future of CS. Have your customers help your customers as opposed to you having to help all your customers. And it's really pretty exciting to hear what Nicola's been up to in London as of today. At least is the fastest growing chapter for the month of September across all of Pavilion, which is a testament to bringing chapters back.
Look at that. Go London.
And with that, thanks for everybody for listening. This has been Sam Jacobs, AJ Bruno, Asad Zaman. Join us this coming Thursday for Top Line Hotline, where we will answer your questions and dig into your deepest concerns on go-to-market. Thanks, everybody, for listening, and we will talk to you next time.
This episode was brought to you by Close, which helps organizations improve their sales win rates, build better products, and consistently uncover the real reasons they win and lose business. Visit freebuyerinterview.com to learn more. Closed, freebuyerinterview.com to learn more. Win-loss analysis is incredibly important. So thank you for listening, and thanks to Closed for sponsoring the show.
Thank you for listening to this episode of Top Line. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.